Hey, the NASDAQ composite just dropped 1.69% today. A really decisive close, lower at 23,195.6.
And the S&P 500 was right there with it, falling 1.07% to finish the week at 6,827.41.
That wasn't just a tough day. That felt like a reckoning.
It absolutely was. And, the driving force today was really singular. Technology stocks, they had their worst session in weeks. And it was all sparked by that colossal, 11+% plunge in Broadcom.
Wow.
Yeah. And for anyone following the market narrative, this sets a new theme. The era of just, unconditional AI enthusiasm is over. Now investors are demanding clear profitability timelines, sustainable margins. It's not just about revenue growth anymore.
Okay, so let's unpack this right away, because what we saw wasn't just a sell-off. It felt like a total change in direction. It kicked off this massive sector rotation and left us with some really, truly bizarre and contradictory signals across the broader indices.
Right.
So our mission for you, the listeners, understand what this new level of scrutiny means for the market heading into a very compressed week of economic data.
And when we look at the data, the severity is it's immediately apparent. The tech sector declined 2.89%.
2.89.
That is nearly 3 times the loss that the overall S&P 500 suffered. This kind of concentrated drag confirms that capital isn't fleeing the market wholesale, it's fleeing a specific idea.
And that idea is?
The idea that growth at any cost is acceptable in the AI space.
And the immediate catalyst, like you said, was Broadcom's collapse, down over 11%, despite what looked like solid headline results. So investors latched onto margin compression concerns and management's somewhat muddled commentary. But why was this so critical? Why did one chipmaker's margin comments send chills across the entire sector?
It's the implication. I mean, when we look at the AI trade, investors have been willing to overlook these massive upfront capital expenditures.
Buying the chips, building the data centers.
All of it, all the research. Because the end promise of profitability seemed, infinite. Broadcom's numbers suggested that the cost to actually deliver on that promise, the margin on the hardware and the chips, is being compressed.
So that hits the whole AI infrastructure chain.
The entire chain. So it's not just a Broadcom problem, it's a future free cash flow expectation problem for everyone.
From the chip makers to the cloud providers.
Precisely. And that skepticism, it spread immediately. I mean, look at Oracle, heavily involved in AI data centers, fell 4.47%.
And that was fueled by reports that some of their data centers for OpenAI are facing delays.
Delays until, 2028 instead of 2027?
Due to material and labor shortages.
Yeah.
Now, here's where I get curious. Is this genuinely about labor shortages? Or is the market just using that delay as an excuse to get skeptical about the timeline for actual AI monetization?
That is a key question.
It feels like 2028 is becoming the new, more cautious baseline for when the real money starts flowing.
And whether the cause is supply chain friction or investor friction, the effect is the same. The tech supply chain is under acute stress. And technically speaking, this selling has put the NASDAQ in a really precarious spot. It's now just 0.35% above its critical 50-day moving average.
Which is sitting at 23,114.28.
Right.
So for our listeners who don't watch technical charts all day, what does that 50-day moving average level, what does it mean in practical terms?
Well, it's a widely watched barometer for short to medium-term trend health. If the index breaks decisively below that 50-day average, it signals a pretty significant change in momentum.
So the big takeaway is clear.
The AI euphoria is no longer unconditional. Investors are asking sharper, harder questions about the true costs. It's a move from grow at all costs to show me the money.
And that pivot leads us directly to the other side of the trade. Massive sector rotation. The capital flowing out of growth didn't just disappear. It sought stability.
Exactly. We saw this pronounced sector rotation for the second straight session, and it poured decisively into defensive plays. Consumer staples led all sectors. It posted a 0.79% gain, closing at $79.42.
Okay.
Consumer discretionary managed to add 0.43%, and healthcare was up 0.31% to $154.06.
So these are the classic safety nets.
The classic safety nets the market uses when high-flying growth stocks come under pressure.
Even financials eked out a small gain.
Right.
0.15%.
Right, and that often benefits from rising long-end yields, which, we can get into. But this rotation is what made the day so bizarre. You had this massive flight to defensives happening while the major indices were flashing these contradictory signals.
It was a day of paradox. The Dow Jones Industrial Average, that index full of blue-chip value stocks, it actually hit an intraday record high.
a record high of 48,886.86.
before reversing sharply to close down 0.5%.
And the Russell 2000, our small cap benchmark, did the same thing. It touched an intraday record at 2,595.98 before finishing down a significant 1.51%.
So the market is saying, I love blue chip value, pushing it to a record, but then immediately deciding to take profits and pull back. What is the market trying to tell us with that kind of whiplash?
This raises the fundamental question. Does this rotation led by stable companies like Goldman Sachs and United Health, does it signify a healthy broadening of opportunity?
Where money is silently flowing beyond just the big tech names.
Or does it precede a broader, more cautious retreat to safety that will eventually hit everything? And what's fascinating is that despite today's loss, the Dow is the only major index still on pace for weekly gains. It's up over 1%.
Wow. That really underscores the power of this value over growth theme right now.
It does.
And of course, that kind of uncertainty is the perfect recipe for volatility. The VIX, the market's fear gauge, spiked 5.99% to 15.74. It hit an intraday high of 17.85.
It did, but, and this is important, you have to keep the context. While anxiety is back, the VIX is still 14.67% below its 50-day average of 18.45.
So we're seeing a sharp move, but deep systemic fear hasn't really taken root yet.
Exactly. Investors are nervous, but they're not panicked. Not yet.
Okay, let's shift gears and look at the fixed income world, because the bond market was having its own reaction to the Fed's decision. We saw the Treasury curve experience what analysts call bear steepening.
That's right. And for our listener, when we say bear steepening, we mean that long-term yields are rising much faster than short-term yields. The market is selling long-term bonds, suggesting investors expect stronger inflation or higher growth in the future.
So they're demanding a higher premium to lock up capital for 30 years.
Precisely. And we saw significant moves. The 30-year yield rose 7 basis points to 4.860%, and the 10-year yield added 5 basis points to 4.190%.
Meanwhile, the short end, like the 3-month yield, it bucked the trend. It actually fell 5 basis points to 3.520%.
It did. So that gap, that spread, the 10-year minus the 3-month, it widened. It now sits at a robust positive 67 basis points.
And this connects directly back to the Fed's hawkish recalibration from Wednesday.
It does. While they delivered that expected 25 basis point cut, the updated dot plot showing only one cut in 2026 really spooked the long end of the curve.
It suggests policy is going to remain restrictive for longer than people hoped.
And the internal disagreement was just as telling. We saw 3 dissenting votes against the cut.
To the 3.5%, 3.75% range. 3 dissents.
That's the most internal division we've seen on the committee since September 2019.
That level of dissent isn't just a footnote, right? It highlights some genuine uncertainty among policymakers.
We even had Chicago Fed President Austin Goolsbee publicly confirm his opposition. He said policymakers should have waited for more data before easing further.
And on top of all the rate talk, the Fed also announced something important for market mechanics, the resumption of Treasury bill purchases.
Yep, about $40 billion total. It's to address funding market pressures after quantitative tightening ended.
Okay, so what does that actually mean? They ended quantitative tightening, or QT, on December 1st, and now they're buying bills.
Right. So quantitative tightening was the Fed shrinking its balance sheet. When they stopped that, some stress appeared in the funding markets. So by buying T-bills, the shortest-term debt, they are injecting liquidity back into the system to keep money flowing smoothly.
So they're proactively managing short-term stability concerns.
That's a good way to put it.
Now, despite all this, the rate backup, the equity volatility credit markets showed surprising resilience.
A huge vote of confidence in corporate America. High-yield ETFs like HYG and J&K only fell modestly.
In fact, high-yield, or junk bonds, actually outperformed investment-grade corporate credit.
By 0.41%. And that outperformance is key. High-yield debt is issued by companies with lower credit ratings, so those bonds are much more sensitive to default risk. When high yield outperforms safer investment-grade debt, it signals that bond investors are confident in corporate fundamentals.
Even if equity markets are nervous about growth timelines.
Exactly.
Okay, moving away from traditional assets, we saw some dramatic outlier moves in commodities and that persistent equity crypto decoupling that's been underway since late November.
Yeah. Starting with commodities, the most dramatic move today by far was coffee.
Coffee.
It collapsed a huge 8.85% to $369.55.
Wow. What happened there?
This wasn't demand, it was a supply shock. It followed Brazil raising its 2025 production estimate by 2.4% to 56.54 million bags.
And that would be
The third largest output on record. So when production forecasts jump like that, prices plunge.
We also saw a strange divergence in precious metals. Gold was up 0.56% to $4,303.40.
Likely benefiting from those safe haven flows we talked about.
Right, but silver fell 2.64% on profit-taking after hitting record highs, and then platinum surged 2.83%.
A very mixed bag. In energy, WTI crude was down slightly, 0.21% lower at $57.48. Natural gas fell 2.53% to $4.12.
Which was mostly due to warmer weather forecasts through Christmas.
Yeah. Warmer weather means less demand for heating, and that presses those gas prices down.
And finally, let's touch on crypto, which just continues to march to the beat of its own drum.
That decoupling from equities shows no sign of reversal, even with the massive tech retreat today.
No sign at all.
Bitcoin declined 3.46% over the last 24 hours. It's at $90,231. It now sits a significant 28.42% below its all-time high.
But the total crypto market cap is still huge at $2.41 trillion.
It is. But what's noteworthy is the high BTC dominance. It's at 74.64%. That suggests that during this phase of uncertainty, capital is concentrating in the largest asset, Bitcoin, rather than flowing into riskier altcoins.
Which explains why we saw the slide in major altcoins. Ethereum down 5.37%, Solana down 4.15%.
Exactly.
Okay, before we wrap up with a look forward, we have to mention two huge individual stock movers that absolutely defied the market today. Starting with cannabis stocks.
A stunning move. Canopy growth was up 53%. Tilray Brands jumped 33%.
That is not driven by quarterly earnings.
No, that is pure high-octane political speculation. It followed reports that President Trump plans to push for loosened federal restrictions.
It just reminds you how sensitive these niche sectors are to political winds. I mean, a 53% jump in one day.
It's a statement. And the other big mover was Lululemon, which rose 9.6%.
This was on the news of the CEO's departure after 7 years.
Right, and investors seem to be interpreting that change after the stock had fallen over 60% from its 2023 peak as a potential signal for a much-needed strategy refresh.
So looking ahead, next week brings a very compressed but critically important economic data calendar.
That's right. Following the government shutdown, these numbers will set the tone.
What's the lineup?
It's a deluge. Tuesday, December 16th, we get the delayed November non-farm payrolls. Then on Thursday, the 18th, we get both October retail sales and November CPI.
And here's where it all connects back to the week's central tension, right? These releases will either definitively validate or seriously challenge that soft landing narrative.
Exactly. Strong employment data could reignite inflation concerns, while weak data could raise recession fears. The market's new cautious mindset is about to get tested by macro reality.
So for you, the listener, the ultimate technical level to watch heading into next week is that NASDAQ composite support.
If selling continues early next week, a break below its 50-day moving average of 23,114.28. Well, that could accelerate this new, more conditional AI trend into a broader equity retreat.
All right. I think that covers today's action. A masterclass in market evolution. The AI trade is maturing, driving capital into defensives, and leaving us with that bizarre index paradox.
And we saw bond yields adjust sharply to the Fed. That's a wrap on a busy defining week.
That covers today's action for the daily consolidation. As always, remember, this is for informational and educational purposes only. It is not financial advice, so please do your own research before making any decisions. If you found this helpful, please like and subscribe. We're back every trading day after the close.
See you next time.